Hello everyone, and now it's time to move forward in our journey and start talking about the consolidation of financial statements. The previous lecture, Chapter 1, talked about the equity method, and the equity method was appropriate when you would not consolidate your financial statements. And there are elements that have to be present to indicate that you do need to now consolidate as a single entity the financial statements of more than one corporation. So the book is going to take us through this slowly, and we're going to crawl before we walk, so to speak. And so we're starting out with Chapter 2, and then as we get into Chapters 3, 4, and 5, the waters will get a little more murky, a little more complicated, but we'll navigate that, and once we have these foundational principles down, it won't seem so bad. So let's get cracking on Chapter 2. Business combinations. Most organizations, large and small, hold some ownership in another company. It's very common. And you have two codification topics on this, 805 and 810, that give us the guidance. And we'll talk about the acquisition method. And you guys, thankfully, have not had to learn the prior methods. Now, there are two prior methods that were in place. We'll talk about them a little bit throughout this slideshow, but I don't want to get bogged down in worrying about what it used to be versus what it is now. But the purchase method from yesteryear is very similar to the acquisition method that we have now. And the good thing about consolidation accounting is we do embrace the fair value measurement. And as you learned from accounting principles and even through intermediate accounting, there are many topics, whether it be fixed assets that are always based on historical cost, and then you depreciate those over time. So it's been cost is a normal method of measurement because one of the reasons it's the most verifiable. What you pay, the actual cost you paid for an item versus what the market value might be, which could be less concrete. But we do get into market value and fair value, as those, I'm using those terms synonymously, when we talk about business combinations. So two things: we have the acquisition method, and it is fair value based. Now what we're doing in a business combination, or a consolidation if you will, is we are presenting as a single entity the information from multiple entities, and we're consolidating them together. Now remember that we dwelled on the percentage ownership, and remember it was a 20 to 50% indicated you need to account for an investment in an investee using the equity method. And once you go north of that 50%, then you need to do a combination or a consolidation. Now, but know this, it is not always that percentage that dictates the need to do a combination. You can have a contractual relationship or lease agreements or any other kind of legal binding document or agreement that indicates that you as the investor or the parent, we'll call it that, have a control situation over another company. Reasons companies do that: vertical integration, which maybe you buy a supplier, that's the vertical integration, versus horizontal integration. Horizontal is when you get into an industry that is not your core industry. There are cost savings, obviously economies of scale can come into play. Financing opportunities, maybe getting something that at kind of a bargain price, or it looks attractive. Diversification of risks. Some of these are fairly obvious as to reasons, and your book talks about some of those. Now this slide has a lot of the some of them not so recent business combinations. I notice we have the airlines, United and Continental. That's happened some years ago, but of course in the airline industry now you've got U.S. Airways and the merger with American Airlines. I believe that has gotten legal approval to move forward, but most of these were in headlines, so you probably have heard of them, and some of them are pretty big values. Now there is a presumption that consolidated statements are more meaningful in that they are necessary for a fair presentation. In other words, you're looking at a whole group of companies in a consolidation. You're saying, how would they, if they were all one, what would it look like? So there's certainly logic to do that, and it's talked about in the codification 810. Just a couple more things on the reason behind this, so that we're not just doing it for the fun of it. It is a value-added thing in financial reporting. And the and know this too, the consolidated companies, you may still have legal entities as separate corporations. There may be obviously a different name, different trademarks, different symbols, and all those things that the corporation builds up over time as like a I want to say trademark, but it's more the recognizable thing of that corporation. Now, they can be achieved through transactions where you obtain that control over the other business, and what we've focused on so far is mainly the stock ownership. It does create a single economic entity from the financial reporting perspective. And we're going to have a slide in just a minute here about the different kinds of events that can happen, and all of which would lead to the need for consolidated financial statements. And this is what I'm referring to. The thing to focus on here, and you might want to just dwell on this slide for a little bit. It's also presented in your textbook. But this first one, they call it a statutory merger through an asset purchase. And remember, you can acquire either assets or the common stock of a company. And obviously, acquiring common stock gives you control over those assets, and certainly then also makes you liable for the liabilities. But if you do an asset purchase and you just buy out all the assets and assume the liabilities, well, the company that's getting acquired, what happens to them? Well, they probably become cash rich and maybe just distribute that cash to the shareholders and just dissolve, just cease to exist. And obviously there's no ongoing need for doing these complicated worksheets that we're going to get into both in this chapter and the next 3 chapters, because there isn't any other entity that you have to bring onto that worksheet. You bring those assets and liabilities onto your books at the date of acquisition. Now, the other term I want you to focus on in this slide is division. You can have a company that it dissolves as a corporation. In other words, its stock no longer exists, but in name and form and location and trademark and what their brands are, that may still continue on, and so you just consider that a division of the parent company. And a lot of your consumer products companies are that way. Procter & Gamble, you still have all different brands and different names of products, not so much the product, but the company that developed that product. So now it may not exist as a corporation, but it's all under the parent umbrella, if you will. The other things on here, this is probably one of the most common things that I've seen in my working as a controller and an internal auditor, is you've got somewhere north of 50% of the stock ownership, and so you still use this term subsidiary. I kind of refer to that, I think, in the chapter 1 video lecture, but a subsidiary is when you certainly do still have that investee remains in existence, and that sub then is consolidated underneath the parent company. Okay. Lastly is the variable interest entities, and of course they reference chapter 6, and we do have chapter 6 on the docket for this course. And remember those special purpose entities, the SPEs, and then they're also called the VIEs, variable interest entity. The Sarbanes-Oxley legislation, I think the FASB realized that it was being misused by corporations to shed risk or put risk off the balance sheet. So now that's no more. You have to bring them on in a consolidated environment. So that's a good thing. This slide talks about the control model and defines, what does that mean? If the reporting entity has the power to direct the activities of another entity, the investee, then these are the criteria for doing a consolidation. This is a really good slide. I like the flow of it. I'm a flowchart guy, but here's what you basically have. You have the parent's financial data, the subsidiary's financial data. You bring those together, and report the results of operations, which obviously is the income statement, financial positions, another fancy way to say balance sheet, and of course then the statement of cash flows. Those are your three major statements. And of course the fourth is the statement of changes in owner's equity. But you bring those together to do a combined statement. You have a lot of back and forth on the reciprocal accounts, intra-entity that we're going to get into. A lot of these are chapters 3, 4, and 5, and then finally get down to a single set of consolidated financial statements. So pretty straightforward, pretty logical in what we're doing here. So what is it that you consolidate? Well, you bring all the account balances together in the financial records of the survivor. Now, this is if dissolution occurs. Okay, so think about this. If that investee company, that what you're acquiring, no longer exists, then yes, I'm consolidating, but I'm doing it with one fell swoop journal entry, and I'm doing exactly what it says. I'm bringing those account balances, and I'm going to journalize them into my general ledger as the acquirer, the investor. I'll just bring all those assets in, bring the liabilities in, and we're done, and just go forward in time. So that's a fairly simple way of going about it. Now, if you have separate incorporation, that's where you're going to have the work papers that you're going to have to prepare. And I'll mention this to you when we do the comprehensive problem. I do expect you to have a mastery of Excel, Microsoft Excel, the spreadsheet. And now, it's not that in practice, that every company that does consolidation uses Excel. Some use Hyperion, and there are other software products that are designed to pull information out of a general ledger system and then allow you to do these where you have to make basically consolidation entries, where you're making the entry not onto the general ledger, but you're doing it as part of this bring together workbook, if you will, to bring all these separate financial statements together. So when do you do this? Well, as I said, if you're going to dissolve that acquiree, you're going to do it at the combination date and you're done. You don't have to keep repeating it. Now, if you're going to maintain that investee maintains as a separate entity, you're going to have to do this at regular intervals whenever you prepare financial statements. Now, I'll tell you that is typically quarterly, and then of course yearly when you're doing your 10Q and your 10K if your stock is traded on one of the public exchanges. So it's not something though that you do on a monthly basis. Most companies try to do a soft close on a non-Q month. So depending on when your fiscal year ends, most companies end their fiscal year the same as the calendar year, so it's March, June, September, and December. You're doing what they'll call a hard close and trying to get everything really accurate, all your accruals really accurate, but you also then have to go through a full-blown consolidation on those worksheets we talked about. And I've already mentioned some of this. How does it affect the accounting records? If you're dissolving a company, then on that company's books, they're going to close out, and you're just going to bring those accounts through your general ledger, record them, and move forward through time. Now, if you're going to have a separate incorporation, in other words, you're not dissolving whatever company it is you're buying, then they continue to maintain their own general ledger. They have their own accounting system, and oftentimes it may be on a separate system altogether, whether they're using maybe J.D. Edwards or Lawson or whatever the general ledger package, or if it's a small company, maybe it's Great Plains or some of these other smaller type softwares. But that's okay, because they can go along and have even their own payroll system, their own payable system, and do their own thing. But at the end of every quarter, they're going to produce a trial balance and produce a set of financial statements, and then there will be somebody on the parent company's staff who's a master at doing consolidations. Perhaps that'll be your job someday. So you'll bring those together in your consolidation software, whether it's on Microsoft Excel spreadsheets or you're using some custom software that's designed for this purpose. And that's what we're talking about, that you do the worksheets without disturbing the individual accounting system. I like the way they phrase that. It's outside of the accounting system, so it's important to know that. So the acquisition method, I alluded to the fact that this is what we call it now, starting in about 2007, I think, is when FASB promulgated the latest statement, where you then moved away from the purchase method, what they call the purchase method, and there was also a pooling of interest method. Now the terminology, it's all acquisition method, which is similar to the purchase method. I don't want to say they threw the baby out with the bathwater, but you're still on a fair value basis. That's important to know. And you're saying, okay, what did I use to buy the business? Did I issue stock? Did I pay cash? And that obviously has you can determine a fair value based on that. You'll have separately identified assets and liabilities. So what is it you're buying? What is the fair value of those assets? What is the fair value of the liability? And you may say, well, how do I know what a fair value of a liability is? Well, like many things in finance or accounting, it's the present value of those future cash flows. So on a liability, it's what you're going to pay out in the future, and you bring that to present value, and that's what its fair value is. And of course, you use a discount rate that's based on the risk profile of the company. And same thing with assets. Now, if you have a tangible asset, fair value, can easily be determined sometimes by what it's trading on a market or selling for on an open exchange market, or maybe it's some type of equipment. You can use appraisers to determine that fair value. So that's one of the first chores that you have to go through when you do a combination. Actually, excuse me, at the time you buy the business, you need to go through that pain to figure out what the fair value of the assets and liabilities are. And I'll mention goodwill in a second, but contingent considerations are, you may have a what if, or you may say if the this subsidiary that I'm buying attains certain performance measures, then I'll pay you an extra amount of money, and that's what we're talking about there, and that also has a value to be assigned to it. Goodwill then is really going to be the excess of what it is you're paying as the acquirer, and you look at all the fair values of what you're getting, the assets and liabilities, and if what you're paying, what you're giving up, exceeds the fair value, the net assets and liabilities, the fair value of those, then you have what's called goodwill. Now, I've yet to see in my personal professional experience a bargain purchase. Normally, if something's for sale, somebody's wanting to, they're wanting to cash in, but it's fairly rare. I mean, it'd have to be a distress situation, and your book does mention that word distress situation. Maybe you're buying something out of bankruptcy, and you truly are getting a bargain purchase. In other words, you're getting some assets, and maybe what you're really doing is taking some liabilities off their hands. But if what it is you're acquiring exceeds what you're giving up, then you've got a bargain purchase on your hands. And it's obviously a great thing if you're an investor and you can find something like that. So more discussion of fair value. You use a market approach, similar market trades. I mean, there are myriad tools that you can use to determine what the fair value is. The income approach has more of a discounted future cash flow of the asset. And you may be looking at the entire business, and most when we do our acquisitions of other radiology practices, we're looking at a multiple of EBITDA. In other words, a multiple of what their annual earnings are and cash flow from that annual operations, and at what multiple is it being sold for. And that's kind of our benchmark on whether it's worth our time to buy it. Now, the cost approach estimates fair values by reference to the current cost of replacing assets. But notice this: I mean, if you don't have a tradable market for an asset, you say, what's it going to cost to replace it? That is an option for you. I would caution against using something like what do I want to insure it for? Because there can be a disconnect between those numbers, between what you'd really cost, what it costs to replace, and what you might want to have as an insured value on that. Well, we mentioned what is goodwill, and this is I don't know what percentage this is in the real world. In my experience, it's been all the time that you do have some element of goodwill after you've gone through and identified the fair value of your assets and liabilities, and that's obviously when you're what you're paying for the business, the investee exceeds the market value of what you're getting. And then, of course, then they have the bargain as the flip side of that. If what you're paying is less than what you're getting. What do you do with the related costs? And it will cost. You have lawyers involved, accountants involved, and direct costs are not part of the fair value received, and they just expense it. It's not. It doesn't have a store of value per se. You're not going to set it up as an asset. You're just going to expense it immediately. And then the same thing on the indirect internal costs of an acquisition. If you're using, company personnel and they're spending time on this, and that does indeed happen, but life just goes on, and you just go ahead and charge their salaries or their wages as expenses. Now, if you register the securities, let's say you're issuing some stock to buy this investee, this company you're going to acquire. And then that's simply going to reduce the fair value of what you're giving up, because it's a cost of giving that up. So know that you're going to net that against the quote unquote purchase price to determine what the fair value is that you're giving up, what you're buying. Okay, if you do, this is typically the case, is you don't dissolve the acquired corporation. Fair value asset is the basis for that initial consolidation, and you still maintain that subsidiary as a legally incorporated entity. Notice the term subsidiary on there. You do not use the term subsidiary when you are talking about the equity method, and certainly remember we mentioned the fair value method when you own a very small percentage, no controlling interest, no direct power control, just the accounting for an investment. You don't use the term subsidiary in that sense. And when you're applying the equity method, you don't use the term subsidiary. This is only used when you're talking about consolidations. Now they use the word simulated. That really means you're doing it outside of the general ledger, and you're doing it on worksheets. So it's you're not recording these things as debits and credits inside the general ledger of either company. You're just acting like you are. The consolidation worksheet, you need to, I'm going to ask you to build an Excel spreadsheet as one of your future assignments that you'll get credit for. So don't fret about this. We're going to work through one where I'm giving it to you in the outline of the comprehensive problem for Chapter 2. But this is the real world, guys. This is how it happens. It's on a worksheet where you go through these steps. And now, what do? So you're going to do an acquisition of an allocation of your acquisition, every time that you do this worksheet, and you'll bring in financial information of the parent and sub on the first two columns. Now the sub's prior revenue expenses are already closed. We're going to show you this. Don't worry about it right now. I'm going to show you this in the comprehensive problem on what that worksheet needs to look like. I think we're going to actually show it to you on a slide here in a second. And then the next step is you're going to take out the equity balances of that subsidiary, and you're going to take out the investment in the subsidiary. Now remember, when you bought it, you did go ahead and record the investment as the parent company. But when you do the consolidation, that investment account is not going to be there. And you're going to allocate those fair values, okay? And any costs you're going to go ahead and set up as goodwill. And you'll combine them all, cross-foot them, and you'll have a consolidated total. And then you'll subtract the consolidated expenses from revenues to arrive at the consolidated entity's net income. Now, this is what this looks like. Don't worry about copying this down. You're going to see it on your comprehensive problem, but this is, let me go back then and talk about what we had. This is your parent, this is your subsidiary, and notice on the subsidiary books you have already closed out. You've got a retained earnings balance that reflects that subsidiary's revenue minus expenses. So you've already closed it out on here. Now for the parent, you are then showing what their revenue and their expenses are, and then you're basically doing a roll forward of retained earnings right here. Okay, there's the income coming in, and they actually paid some dividends, and then you just snapshot the balance sheets of both companies, which is what you're doing here. Now notice at this point you have not recorded goodwill or customer contracts or any of those things. You have recorded the investment. Okay, this is what when you made the transaction to buy whatever 60% of the stock or 90% of the stock or 100% of the stock, whatever it is you bought, you're showing that investment in there. Maybe you gave up some equity also, but at this point you haven't. You know, on your general ledger you didn't put any goodwill. You're going to show goodwill on the consolidation when you go through these entries to create that this consolidated set of financial statements right here. And this is what would go on to your 10K or your 10Q. Some additional issues on the intangibles, just the definition of what those are. Obviously, lack physical substance. But we don't. You can have an account receivable that's not considered an intangible. They're obviously a receivable or does not have physical substance to it, but it's considered a financial asset or financial instrument. And so don't confuse that as being an intangible. And most of your intangibles are arising from some kind of a legal right or contractual right. You can have copyright, service marks, those kinds of things. And you can sell an intangible. Okay, I can sell a copyright. I can sell something that has that legal value to it. Now, what do we do with and goodwill is one of your most common intangible assets that arises from an acquisition situation. Now, if you have pre-existing goodwill on the books of the acquired company, the investee, then you ignore that. When you're buying them, you're not saying, oh, what is that goodwill really worth? No, forget about it. You're looking at the identifiable assets and liabilities, and you want to get the fair value of those. But you're not trying to stare down goodwill that already existed, because what is the situation? That subsidiary that you're about to buy could have on its own years ago purchased some other company and had goodwill on their books when they did their I'll call it purchase accounting. If it was years ago, that'd be the case, or their acquisition method, but you now in this current transaction are going to ignore that. In-process research and development, that's what IPR&D stands for. Under the acquisition method, it is okay to consider that to be an intangible asset. And of course, ongoing research and development costs. This has been true for a long time. Just expense that as you incur it going forward. This slide, I won't dwell much on it. It does show that there is convergence between U.S. GAAP and international standards. So that's a great thing. There are your codification references, 805 and 810. And on IFRS, I'm not an expert on IFRS, but I can tell you this. What I do know of IFRS, there are really not that many instances or topics where there is divergence between international standards and U.S. standards. Most of the time they're going hand in glove with each other on different topics. Now, this slide's a little bit not coming in order here, but this is some of the history where we talked about the purchase method and the pooling of interest method. Pooling of interest was a case where if you were giving nothing but common stock, if you're the acquirer, the investor, and you're doing nothing but issuing stock to acquire this interest in an investee, then you had an option of using that, or that's actually when you would use the pooling of interest. And the thing that was different about that is you brought over in your consolidation worksheet, you brought everything over at book value, not fair value. So you wouldn't have goodwill when you did the pooling of interest. The purchase method really is very similar to the acquisition method that we refer to today, and you did have goodwill. It still had a fair value element to it, but if you couldn't use pooling of interest, then you defaulted to using the purchase method. And the thing I would say is different about purchase method versus what we now call the acquisition method. Acquisition method, you are focusing on the acquiree and their assets and liabilities and really drilling down on what the market value is on that acquiree's assets and liabilities. Purchase method, you more were looking at what you're paying, what you're giving up or paying for that interest in the investee, and that was really where you would derive, okay, I now have, I know I'm giving this up, so now I'm forced to just allocate it best I can to those assets and liabilities of the acquiree. But these two are no longer used, but they do continue on in legacy reporting. So by the time you become a chief accounting officer after you graduate from California Baptist, maybe this will no longer be actually even used, because you would have gotten rid of maybe that investment that you're still using a purchase method on. And again, I don't want to dwell on the differences, and I'm not going to hold you accountable for that on the exam. But here's a slide, and this is also covered in your textbook pretty well. Now, again, you still have a bargain purchase situation if your purchase price was less than the fair value. Again, most of the time you're only going to see that in a distressed situation. But these are really what you did under purchase method when that happened. In-process R&D, this is another key difference. You used to expense that every time under purchase accounting, and now under acquisition accounting, the acquisition method, you're okay to recognize in-process R&D as an asset. So that's one of the key differences. And again, the pooling of interest was where you're giving up nothing but stock. There's no other cash. Okay. And then you leave the combination intact going forward, and it's a book value basis. So just know that it was book value, not fair value basis. Okay, and there's the term book value. And again, I'm not interested that you really have a command of these older methods. I really want to know, though, that you do have a command of acquisition method, and that's what we're going to cover in our comprehensive problem. So in summary, consolidation of financial information is required when you gain control, and very often that control is determined by the percentage of stock, but it does not necessarily have to be the percentage of stock that you own of that investee. And we require what we call the acquisition method, which is fair value based. And you recognize goodwill if the purchase price exceeds the fair value of those net assets acquired. Net assets simply mean the assets minus the liabilities. That is your net assets. And then if you have a bargain purchase, if the fair value of assets exceeds the purchase price, and then you just record a gain on that.